Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Grant White, portfolio manager and investment advisor at IA Private Wealth, will be joining us for the hour. And in 30 minutes, Tom Curtis, president of Burger King, will be coming on to discuss how the company is pivoting to keep up with growing volatility in the fast food sector. And of course, we want to hear from you this morning on First Call. Reach out with your questions on Canadian value and technology stocks, and we'll have Grant White answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. The U.S. and Iran have agreed to a 2-week ceasefire, and Tehran has pledged to reopen the Strait of Hormuz. Ship owners are now rushing to understand the terms of the deal to provide an exit window for more than 800 ships trapped in the Persian Gulf. Iran has agreed to safe passage in coordination with its armed forces and within technical limitation. Well, U.S. President Donald Trump said the U.S. would be helping with the traffic buildup. Shares of Delta are soaring in the pre-market. First quarter profit and operating revenue for the airline beat analyst estimates. The company says demand has improved and bookings were strong in March. Premium cabin and loyalty-driven revenue also cushioned the impact of higher fuel costs. The airline also says it expects to incur more than $2 billion U.S. in higher fuel costs. Shares of ExxonMobil are down in the pre-market, about 5.8% right now. The energy company says 6% of its global first quarter production was knocked out due to the Iran war, impacting much of the energy industry in the Persian Gulf. First quarter earnings at Exxon's energy products division will be $3.7 billion U.S. lower than the previous quarter. The company attributes this to price volatility and the timing of cargoes. And now our top line story. Markets are rallying after the U.S. and Iran agreed to a temporary ceasefire. Look at the NASDAQ right now. The future's up more than 3.5%, but even the Dow and the S&P 500 almost 3% right now at this point. We'll see what happens as the day unfolds, of course. But the stocks are surging across global markets, and oil prices are tumbling. Look at that, down 17% for WTI for May. $20, it's down to $93 a barrel and going even lower. Okay, for more on this, let's bring in our guest for the hour, Grant White, portfolio manager and investment advisor at IA Private Wealth. Grant, thanks as always for joining us.
Thanks so much for having me. What a day to be here.
Yeah. I think I've said that every day for about the last 2 or 3 weeks, but I guess this is a bigger what a day to be here than other days.
Yeah, you bet.
The markets right now, we're looking at the futures and Europe and Asia. The Kospi is always just fun to watch because it's like, I think it's up 7 or 8%. It's just like a roller coaster. But Europe's up as well. Are they overreacting, or is this?
This is going to be interesting, I think. I mean,
I'll leave it there.
Yeah, I think, are they overreacting? No, I don't think so. But at the same time, we know that this is a very fragile situation. Like there's still ongoing conflict going on right now.
I know, we're still hearing shots fired as we speak.
Yeah, exactly. So it's very fragile. Everybody's saying it's fragile too. So the market reaction, I think, is fair because, like, if you go back to prior to this conflict going on, you remember the stories we're talking about? I mean, like AI security and things like that. Like, that would be great if we could get back to those types of conversations, obviously. And so what the market is obviously hoping for is that's what we're getting back to, is the more boring stories out there. But yeah, so I don't think they're overreacting per se, but I do think that we are up for a roller coaster ride in this still.
Yeah, because we also saw quite a strong recovery last week too.
Yeah, exactly. And that, I think that was more of a reaction to the overreaction that's happened throughout this. I mean, nobody expects this to be a long-lasting conflict, especially given the pressures that the President Trump is facing back at home more than anything. And so I expect that this is going to be short-term. Hey, we all hope that this is the end of this coming up here. And certainly the market is showing that it hopes for that today. But I would say for investors out there, you got to be a little bit careful. Don't just expect that the story's done. There's a lot to get through here.
So what are you doing right now with all this, what that's been unfolding? And on a day like this, are you jumping in, or are you sitting there and going, hang on?
Yeah, well, I think for one, I'm glad that we're in because this is like catching a falling knife. It's incredibly difficult to catch a market like this, and the reality is, if you miss just like a good days a year, your whole year could be shot in terms of market returns. And so this is looking like it's going to be one of the best days of the year, if not the best day of the year. And so hopefully you're invested. The key to all of this, and we're right to the beginning of this event, is that you need to stay invested throughout this, and a diversified portfolio. Particularly a globally diversified portfolio can help you to weather the storms and get through it. And then you get a day like today, and then you're participating in it, which is great. Because trying to buy into this market today, I think is going to be very difficult.
How have you done for the year? Like, how are things shaping up with it?
Yeah, well, I'm pleasantly surprised, I guess, when we were looking at portfolios last week, and we were still positive on the year, given where the stock markets are around the world, and generally off 5 to 10%, give or take, which market. So pleasantly surprised that we were still hanging around the flat line there, and really well positioned for what's coming today, and hopefully what's coming down the road this year.
Yeah, I was looking at your notes. What is it? 10 days if you miss?
Yeah. So if you miss just the 10 best days over 10 years, your portfolio returns could be cut in half over that 10-year period of time. So the key to all of this is you just got to stay invested. You got to stick to your discipline, stick with your philosophy, and no matter what's going on, don't try to catch the falling knives, as I say. Yeah.
I like that one.
Yeah.
So with that, does your philosophy change though? Like, does it change over the year? Does it change? Is it a seasonal to a degree? Like, obviously you're looking at how things are flowing, but also as you age, you're going to change what you need and what you want. Should you be adjusting that?
Yeah, I mean, you gotta adjust for your life for
Yeah.
sure. And as an investor, that's what you should be focusing on more than anything. But not necessarily the seasonal change or what's going on in the macro environment. I think that what does change, though, is where the opportunities are. And what we have seen, and it's been difficult over the last couple of years with such dramatic growth, and especially a number of areas, it's difficult to find really great opportunities. Now, I mean, hey, war is bad and conflicts are bad. But when you look at what the market has done, just purely on the market, we have seen some opportunities come up in the last little while because prices have come back a little bit. Frankly, not as much as you might have thought or we might have thought could have happened, but that does bring opportunities into play. And so then we can pile into those opportunities and take advantage of lower pricing when that does happen.
What's some of the best opportunities you've seen over this last?
Well, some of the best names out there, I think, that have come back is names that are probably more boring. I mean, actually, one of the companies.
Sometimes boring is good.
Yeah, absolutely. I mean, one of the companies that we've been actually focusing on a little bit more is Canadian Tire. And because, like, in all the noise of AI, Canadian Tire has been doing a really great job of using AI to push up their revenue, to create better customer experiences. And so companies like that, I think, are really taking advantage of the new technology that's out there and improving their business. And so when you get pricing opportunities on a really boring company, like I say boring in the fondest way possible.
It is.
You know,
the nicest way.
But it's like when you get an opportunity on a really great company like that, then that's great. Because otherwise, you don't get the pricing opportunity that we've seen in the last while. Obviously, we're watching the big ones too. But
Yeah. Okay, we're going to take a break on that note there, but we'll be back. And first up, look at the markets before the bell. Let's see how things are shaping up on the markets. Pretty easy to guess how they're looking right now. We'll start with U.S. futures, and look at that right now. The Dow and the S&P 500 up almost 2 3/4 of a point, and the Nasdaq is up 3.5. All of this on the news of the 2-week truce in Iran. Still rockets being fired over there, so who knows what will happen. Maybe we'll see what happens when the markets open, and we'll see what happens by the end of the day. For now, that's where we stand. That's the way it's been going. Now, Asian markets, they were liking what they heard. And look at the Nikkei. It's always a little more volatile, but it was up 5.4%. Hang Seng, though, still seeing a rally up more than 3%. And the CSI 300 up 3.5%. Again, on that news out of the Middle East. Heading to Europe. And such a similar situation, really reacting in Europe. They had been feeling the pressure with natural gas and possible fuel shortages. The FTSE up more than 3%. CAC 40 by 4.8%, and the DAX up more than 5%. The austere Germans reacting today. And the TSX yesterday, of course, like everybody else, it was down most of the day, and then it had that rally at the end of the day, up by 0.17%, and we'll see what happens with it today. Some of the movers and shakers from yesterday. Wesdome Gold Mines up 6 3/4. International Petroleum up 4 1/4. Going the other way. Go Easy again down 6.6. And Curaleaf, it is on a roller coaster, down 7.7 almost. And gold reacting, silver reacting, copper reacting to everything we're hearing out of the Middle East. Gold looking good again, up more than 3%, up to 4,800, over 4,800, pushing towards 5,000 again. Silver is up more than 7.5% at 77.5 an ounce, and copper is surging nicely as well, up 3.5%. Western Canadian Select, this is a tale of 2 days right here. Yesterday, it was up 0.19% to just below $80 a barrel. Now, let's look at WTI for today. And this is what we'll likely see with Western Canadian Select later on. But WTI down 18%, $92 a barrel on the reaction from the news out of the Middle East. Okay, for years, financial advice has been about delaying today for tomorrow. But according to our guest, there is a simple truth investors need to rethink. No amount of money can buy time. The real shift, balancing long-term security with living now. We're back with Grant White of IA Private Wealth and existentialist philosopher.
Well,
I don't disagree with you, though.
I think you made a good point.
I do not disagree with you.
Yeah, I think you made a good point. I mean, the industry that we're in has done a really good job of getting people to delay gratification, and unfortunately, not everybody gets to it, you know.
Yeah.
And we've all seen that, and so I think this is a conversation that we're having on a regular basis right now, and I think it's a very important conversation that has been missed for a very long time.
Well, and there's a little bit, to a degree, I think it could be fear for investors because, if I take money out now, that money would, I take $10,000 out now, well, it would have been worth $100,000 in 20 years.
Yeah.
But I mean, now the $10,000 is worth a lot to you, though, depending on how you're using it.
Yeah, I mean, I think you're absolutely right. And there is that cost of breaking up the compounding in certain areas. And so you do need to be mindful about that because there is long-term goals, there's short-term goals, there's medium-term goals. And I think the conversation just needs to shift to they are all important. And again, the industry's been really good at creating products around retirement, and that's great. But the unfortunate fact is that not everybody gets there, and there's a lot of life between now and then. And I just, I'm a big advocate that you need to enjoy the journey along the way. Otherwise, what's it all for, basically? So, one of the things that we need to start having more conversations about is what are you doing today to make sure that, yeah, you're planning for the future, but you're also enjoying the experiences and things that you could be doing today. And if it takes, I was chatting with a friend of mine last week. He's older than me, but one of the things he did was he and his wife were adamant about taking family trips every year, and he was never apologetic. In some years when business wasn't as good, they had to take some money out of the RSPs because the memories that they made with their kids today, and it's easy with hindsight now because you can look back and say we're all good, but the memories they made back then, are incredible, and they helped shape their family.
Well, a friend said that to me. We were talking because I'm getting close to that, not yet, but retirement age.
Yeah.
And we talked about that. And he said, if you do a trip at 70, you remember it for 10 years, maybe. If you're lucky, right? You remember. But if you do it at 40, you have your whole life of remembering it.
Yeah.
And you have and that is it is worth a lot in your life. But how do you do this though? I mean, if you're lucky, you're earning, you have a good earnings. But if you're in that, $30,000, $40,000 income bracket, $50,000, it's not easy to say, I'm just going to take some of that money out because there's not a lot of money to take out.
No, and that's really, really fair. I mean, I think like we're talking about traveling, big trips. Those are big ticket items. But, people also need to enjoy their daily lifestyle as well and things that, are within their means. And so whatever that is, I think you need to, I mean, I go back to like when I started in the industry, everybody told me it's like, don't buy Starbucks because that $5 cup of coffee, if you save that up through there, you can buy a car. What they missed in that was I really enjoyed Starbucks and made my day better, and it still does. Frankly.
Absolutely.
And so you got to find those happy within your means, whatever that happens to be. Even if it's like a weekend trip out to the lake or something like that, creating those memories are so important. And yeah, it's worth it. It's worth the cost of it. And if that means you have to work one more year in your career, I think that's worth it along the way.
But it takes some discipline, though, too, because you do have to balance the two things, don't you? You can't just suddenly go, I'm going to live for today, and you're the grasshopper, not the ant.
Yeah, I mean, you make a really good point because I think we've had people at both spectrums on this. On one end, people were not planning for the future at all, and they had their head stuck in the sand, and basically were just like, yeah, I'm living for today, and I'm not planning at all. On the other hand, people were delaying everything for today, and they were planning for retirement that they may never see, or it's going to be maybe shorter than they want it to be. Both are really sad situations, actually. So you got to meet in the middle on that. I think it's just a matter of being intentional about how you want to spend your time, and also looking at like, what are you doing today in your time, and don't, be compassionate to yourself. Don't feel too guilty if you're binge watching a show on the weekend every once in a while. But I think you need to look at like, how are you actually spending your time? Be intentional about it, and then start setting some goals around it. I'm a big advocate of having like a full year calendar, like something on paper that you put on the wall, and then you can kind of map out your year. That doesn't work for everybody, but that's something that I talk to a lot of people about, is just getting it all visual and getting it on paper, and talking about, especially if you have a spouse or a partner, talking with them about how you actually want to live the next year, and then go from there and just plan it out.
And are there ways to do it with a financial benefit almost, in that, do you put some money in, let it invest, and then you take it out, or do you just leave that money set aside?
Yeah, absolutely. I mean, like, hey, we know, I mean, we talk a lot about stocks, obviously, as a longer term investment, but there's shorter term investments and medium term investments that can help you to accomplish your goals. I mean, one of the conversations I'm having regularly, we were talking about gold and, near all-time highs still. Is some of our investors who are hanging on to a little bit of gold, like should they sell that and move it to something that they can use in a shorter term period of time? Probably not a bad time to do that, and then move it over to something that's going to earn you a little bit, but it's available to you in the next year or next 2 years when you want it.
All right, we're moving to California after this.
Yeah.
Coming up, AI is scaling up fast, making products easier to copy. What does that mean for brand identity? More on that next. AI is getting bigger every day, and there's a growing belief among investors that it's making products cheaper and easier to replicate. Some disagree, saying the shift does not diminish brands, but actually makes them more important than ever. Let's bring back Grant White of AI Private Wealth. Not IA. Okay. It is. I haven't really heard this topic before when it comes to AI. That it's the brands matter as well, because everybody just talks about how much it's going to save, what's it going to do, it's going to replace jobs are going to be lost.
Yeah.
How do you see this strengthening brands?
Yeah, so I think this has become a more popular topic, and some very famous podcasters have recently talked about how this age of abundance that AI is going to bring on could eventually eliminate the benefit of having brands, because everything's just going to be so abundant out there. Sounds like a wonderful world. I completely disagree with the take on the fact that brands aren't going to be important in that world. And I would actually argue
a little bit Pollyanna, it seems.
Yeah, and I would argue it's the exact opposite, actually. I mean, in the age where we're commoditizing down, whether it's technical skills or even production, brands are going to matter that much more, actually, because people. I mean, at the end of the day, what's going to be the difference? Like, what are you going to buy versus that if they're all basically the same?
It'll come back to trust.
Absolutely. It comes back to trust, and more importantly, it comes back to that emotional connection that you've got to something. I mean, when I see things like this going on, I think back to like Apple's famous campaigns, like Think Different campaign, right? And ultimately how they separated themselves from the rest of the computer industry at that time.
They do amazing boxes.
Yes.
Right? No, they really do.
I've got 5 of them under my desk for no reason. They're empty. Yeah, absolutely. So companies like Apple, Patagonia, for example. I mean, I was watching Patagonia. They're taking on the U.S. government and forestry the other day. They're taking stands on things. And I think that the really smart companies are already ahead of this. I mean, they've been doing this a long time, but the really smart companies are also really pushing in this direction again, because they know that a lot of what they do is being commoditized down by AI. The story in AI is not going to be efficiency. That's a given in this whole thing. I think the story is really going to be how it elevates certain experiences, certain connections, and the companies that brand around that and do a really good job about that, I think, are going to do really, really well.
Are they embracing AI, these companies? Like, are they?
Oh, they better be.
I mean, you can't sit there, like, you want to keep your brand, but you have to bring it has to come. Like, it's inevitable, right?
Yeah, there's no choice. But I think that the misconception is that a lot of the benefit from AI is going to happen naturally, because you actually have no choice on the efficiencies that it's going to create. Where I think companies are going to be really successful, and I mentioned Canadian Tire earlier in the show, they're a bit early in the game, and I think they're doing really, really well on that. So I'm excited about what they're doing in that company. I think we're going to see a lot more of that in the years to come. But I'm also excited about what a company like, again, I'll use Apple as an example. Great brand, obviously. How can Apple position themselves as that continuing brand, that creative brand going forward, and will people continue to buy into that story? I think they will. But there's a lot of companies that are much smaller than Apple that I think are a real opportunity in that as well.
And it's a fine balance, though, with AI too, incorporating it, because the one thing people are hating, they're loving and hating because you can get some answers, but talking to AI. I had a company that was texting me, and it was AI about, hey, when are you coming back to do this?
Yeah.
And I'm like, no, you're not a real person. And I was angry.
Yeah, so authenticity is what matters most in all this, right? Because there was that blowback around Christmas time around all the ads that were AI generated, right? We saw Coca-Cola come out with their ad, and people love the old Coke ads. I mean, if they don't go back to doing real things, then I think Coke has really missed the mark. Whereas Apple has done the exact opposite, and I'm plugging Apple a lot here, but they have made some really good decisions around just going back to regular film and getting people in their ads and so on and so forth. And I think that is something that we're craving today. And in this world where community has become lacking since the pandemic, I think that's something we're craving today. And I think that AI is going to give us a better opportunity to create it if the companies do it right.
I know. I was looking at one of your notes you bring in. You mentioned is Artemis.
Yeah. That's just it. I'm looking at the moon every single night.
Yeah.
Because there's these 4 people out there, and it's such a great story. I mean, arguably the technology is obviously better than 50 years ago when we went to the moon. But this isn't really a technology story, but this is a human story that's going on, and you see the stories that they're sharing from the spacecraft as they're coming back home now. I don't know about you, but everybody I know is talking about this, and I think it's a fantastic story. And it just highlights to me, this isn't necessarily an investable story today, although there is going to be a lot of space investment. I think that what it highlights to me is that this is what people are looking for today.
Now, but how do you balance it? Because I mean, a lot of people look at, it's AI generated, because there's so, especially now on social media, the amount of AI generated stories, and they're getting easier to pick out, and you get angry. So how does a company how does a company tell their story and say, no, this is a real story?
Yeah, I think that it is a harder thing to do for sure as AI gets better and better. But that's not necessarily a bad thing either. I mean, I think what's most important in all of this is the feeling that people are getting from it, and if they feel it's authentic, it comes back to storytelling though more than anything. And some of the people that I'm following are telling stories about their journey along learning how to run a marathon or improve their times. I think that human story is going to be that much more important, and the companies that really buy in and lean into that are going to do extremely well. There's going to be commodity companies, and they're just going to, and at the end of the day, it's a cost story. Yeah. But the companies that really want to sell at a premium price, again, Apple's a good example of that. They're going to have to tell a more human story going forward.
All right, I like humans. Okay, still ahead, we're talking to another human, Tom Curtis, president of Burger King Canada, about its upgraded menu and what it means for the fast food industry across Canada. And of course, our phone lines will open up soon for our first call segment. You can reach us, 1-855-326-6266. Send us an email as well, firstcall@bellmedia.ca. Algoma Steel has entered a joint venture with Rochelle to create Rochelle Algoma Defense Solutions. Rochelle is a Southern Ontario-based defense manufacturer of smart armored vehicles. The goal is to manufacture ballistic steel for armored vehicles for Canada's defense industry. The companies say the ballistic steel can also be used for other industries, including infrastructure, marine, aerospace, and security. Shares of Shell are lower in the pre-market. The energy company says price volatility caused large swings in inventory values, pushing working capital. The UK-based company also lowered its first quarter guidance for integrated gas production. Meanwhile, Shell says weaker first quarter gas output and a hit to short-term liquidity would be offset partly by stronger oil trading. And shares of Levi Strauss are soaring in the pre-market, up more than 11.5%. The jeans maker boosted its profit and revenue forecast for the full year. First quarter sales and revenue for the retailer also topped estimates. The American company is citing strong demand in all regions as it steers shoppers to its own stores and website. Separately, Levi announced its chief financial and growth officer will be stepping down after more than a decade with the company. And looking at the markets right now, you can see still well into the green over the news of a 2-week truce in the Middle East and Iran. And the Dow up by 2.6, the NASDAQ by 3.35. It's dropping a little bit, but still up. The S&P 500 up by 2.63. Burger King Canada is making a shift to its core menu items, including its signature Whopper Burger, fries, onion rings, and chicken nuggets. We're looking at what it says about the fast food industry in Canada right now. Joining me to discuss the shift is Tom Curtis, president of Burger King. Tom, thank you very much for
Good
joining
morning.
us.
How are you?
Good. Thanks very much for joining us. Why this move rather than go after launching limited time offers?
Yeah, I think everybody's out there launching limited time offers from time to time. And really, the reason for being for Burger King is the Whopper, flame grilling, and having it your way. So I think leaning into those powerful equities is the right thing to do. This all started really 3 or 4 years ago when we started upgrading restaurants, operations, and franchisees. And this is the culmination of that upgrading or elevation effort.
That's great, Tom. I'm just curious on what's the main reason? Like we were talking about, like especially younger customers and what the trends we're seeing. What's the main shift behind these moves today that you're seeing, and what are you hoping for the outcomes?
Yeah, so interesting that you mentioned younger customers because when I travel, and I travel a lot, I'm getting on airplanes, I'm out and about in the markets, and a lot of people say to me, I used to love the Whopper, or my dad's favorite burger was the Whopper. And that bothers me. And so we really needed a signal to the market that we're worthy of a try from younger guests, from guests who haven't been to us for years. And I think that's why this is an important move for us.
And I mean, you're also facing the challenges with weight loss. I mean, there's a huge weight loss growth going on right now. People are staying away from fast foods, or the perception is they're staying away from fast foods. How are you bringing them back in?
So I think the key there is, we have our signature Whopper. We have the innovation around the Whopper, like a peppercorn Whopper or a maple bourbon barbecue Whopper. We make those available in our Whopper Junior also. And that's really our answer to this GLP movement. You don't have to sacrifice flavor and taste and quality because the Whopper's too big. It's available in a smaller package as well, and we're finding that consumers love that.
Tom, you should have sent some of those over so we could have tried them out, I think, You're
I know somebody will get it done.
Yeah. You're obviously, going into more premium, it sounds like more premium ingredients here, and I assume that has a cost factor assigned to it. My question is more about, do you see automation in any way being a way that you can help to manage costs as you're looking to put in more premium ingredients?
Well, when it comes to automation, period, we obviously are leaning into AI like everybody else is. But the way that we look at AI and automation is it's an enabler. It's not a replacement for labor. And I learned this at a prior brand that I was part of. If you enable people to be able to respond to increases in volume that always happen, then you'll grow traffic over time. And growing traffic is the only way to succeed in this business. Trying to cut costs is not.
Now, you mentioned about keeping staff. I mean, labor, though, is a huge cost, especially in Canada, minimum wages and things like that. How are you balancing that, keeping them, but still bringing in AI and automation?
Well, if you provide a great workplace, and we've gone from, at one point in 2018, to having 3% of our restaurants remodeled to now 75% and moving quickly toward 100, then you've got a great work environment. And once again, if you provide the technology tools that the workforce desires and wants and needs to perform their important tasks of taking care of guests well, then your workforce gets sticky. And then once again, when traffic and volume do increase, then they're ready to handle that. And you don't need to add a ton of additional labor to manage that.
Tom, just on the future of this, I mean, obviously you hope this is going to go well for you. What do you see the next steps following these moves are going to be, and what can investors look forward to?
Yeah, I think you would continue to expect for us to elevate across all fronts and all guest touch points. So there are other parts of the menu that could use elevation as well. Because really, once again, long term, this is not, shrinkflation doesn't work. Cutting costs doesn't work. It might work for a quarter, it might work for a half, but it doesn't work for the long run success of the brand. So what you can expect to see, what you can expect to see in Canada is that the brand will continue to be a premium offering and something of a reward for people who want to access great food. but without sacrificing and also being able to get it at a reasonable price, because that's also the promise of the quick service business.
Now, I want to get back to AI, Grant. Now we're just talking about how AI, the concern is it'll affect brands negatively, but there is a space for people to take advantage of AI and strengthen your brand. How are you using AI, and what are you watching for that may hurt your brand, and how do you think it'll help your brand?
Yeah, so on the technology and AI front and how we're leveraging those to make our business better, we've developed a tool for our operators and our team members called BK Assistant. So if you can imagine just a headset that's talking to you all day and giving you the information that you need to provide a great guest experience. For example, hey, you're running out of a certain type of beverage, or your shake machine just went down. Can we call somebody for you to fix it? That's how we think of leveraging AI. If it's connected to all the different touch points in the restaurant, then people can leverage it once again to fix things, to help things, to make sure we don't run out of things. And then most importantly, our team members can focus on an interaction with the guest versus having to respond to distractions to that excellent guest experience. So that's how we think about it. Once again, I've had experience with this in a past life, and I know that's the best way to utilize technology.
Tom, this whole conversation has reminded me of a really great book on reasonable hospitality. I don't know if you've read it or not, but one of my favorites. It's a must-read at our company. One of the things I'm thinking about is obviously they talk a lot about Shake Shack in that book. What do you want people to feel when they're coming into your restaurants? Like, what do you want the experience to be, and what do you want? I was talking to a few people here. We haven't been to Burger King in a while. So what would you say? Why should we come back, and what do you want us to feel when we're there?
It's so simple. The first thing that you should get when you walk into a Burger King restaurant is a smile and a hello. Now, those things are built through culture over time, but we are laser focused on getting those things right. It's a smile, a friendly hello, and I'll be right with you. Just an engagement, because I'm sure you know this. You go to some restaurants these days, and it's almost like people are hoping that they can just go about their business and not have to interact with the guest. And I know when many people walk in, if they don't want to use a digital touch point, like a kiosk, they want to talk to somebody. And so I think that just getting that right, and I love that book. And we have our folks read it as well, because just, making that one little touch, that one little interaction special can make all the difference in the world, and kind of covers for any mistakes that happen from time to time.
All right, Tom, we have to wrap it up there, but thank you very much for joining us.
All right, thanks for having me.
Tom Curtis is president of Burger King. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Stella Jones. And of course, our phone lines are open. Grant White taking your questions on Canadian value and technology stocks. Call us at 1-855-326-6266. Email firstcall@bellmedia.ca. Let's take a look at some of the notable analyst calls and recommendations. Stella Jones has been cut to sector perform at National Bank. The analyst citing a desire to find a better entry point and seeing static earnings expectations at odds with share price rally and weak earnings breadth. Verizon has been cut to hold at DBS Bank, but raised their price target of the stock to $52. The downgrade comes amidst significant restructuring efforts of Verizon, which includes cutting thousands of non-union management jobs late last year. Now, Jefferies has upgraded Deere to hold from underperform with an unchanged price target of $550. Shares dropped roughly 15% following a sharp rally earlier in the year, which brought the share price closer to Jefferies' unchanged $550 price target, making the risk-reward ratio more reasonable. Ship owners across Asia, the Middle East, and Europe are greeting the potential reopening of the Strait of Hormuz with a mix of relief and caution. The focus now on what a 2-week U.S.-Iran ceasefire could mean, including the possible release of more than 800 vessels trapped in the Persian Gulf. Bloomberg's Alaric Nightingale has more.
Al, I do wonder, how is the shipping industry reacting to this news this morning?
It's much along the lines of how you just summarised it. I think there's a lot of caution. What is this ceasefire exactly? How agreed is it? Are all the parts of it? There are so many things that are kind of unclear. If you look at the 10-point plan that Iran is supposedly putting forward, there seem to be different kind of demands that we're seeing. So what's the actual detail of the plan? And then, do you want to be the first wildebeest in the river to check if there are crocodiles? So that's, if you're an owner, you're looking at the other guy and saying, are you going to go first? No, you, and see, build up some confidence. And one of the things that people are saying to us this morning is they need to see others go first and see how the kind of the safety looks in practical terms when you start to see transits, and then they'll take a view. So it's a kind of a chicken and egg situation. And the same goes for insurance even. That's going to be, if this becomes a normalised situation, the first step is, or one of the key steps is going to be insurance. The very first one probably going to charge quite high prices, and then you'll find a more kind of appropriate market level as you understand the risk. So all of these kind of things are a chicken and egg process to just try and sort of figure out how safe it really is, and that's where we're at right now. It's
interesting when you look at the shipping stocks in Europe this morning. You've got Hapag-Lloyd up 5%, so clearly relieved, but Maersk down 1.4%. Kuehne and Nagel only up 0.25%. I wonder, is it that different shipping companies have different obstacles to get shipping traffic back to normal?
I mean, there's some of that, and there's probably a lot of kind of aspects of their operations and their kind of logistics that are very different. So it might be about fuel costs. If you've got a particular kind of hedged position or an unhedged position, and suddenly you've got much lower fuel costs, that could be very helpful to you. I'm not speaking of those particular companies, but you will see a kind of a fair degree of variability between two different shipping companies about how they might respond kind of stock-wise to a more kind of peaceful situation.
That was Bloomberg's Alaric Nightingale. Fuel surcharges, rising food prices, and economic uncertainty are among the impacts the war in Iran is having on Canadians, with many bracing for a rocky spring and summer. CTV's Heather Wright has more.
English cheddars, French bries, provolone from Quebec. Good Cheese in downtown Toronto stocks products from around the world and is among the many now grappling with the impacts of world events.
The first thing that you're going to notice is the price of shipping is going up. So that's definitely we're feeling the pinch on that.
Not only are shipping costs up, owner Luke Champion says so too are the prices of many cheeses he sells from both international and domestic suppliers. Champion is absorbing as much as he can, but worries about the unknown.
We're feeling it a little bit, but we're concerned about what's to come.
Businesses, households, grocers, and airlines are all feeling the impact of the war in Iran, now in its 6th week. The average price of regular gas in Canada is up 51 cents a litre since February 28th. Diesel has climbed an average of 74 cents a litre, while jet fuel has surged $1.05 a litre. And many companies have already begun passing these prices along to the consumer. Air Canada, WestJet, Porter, and Air Transat have all added various increases to their airfares or vacation packages, while Amazon will charge sellers a 3.5% fuel surcharge on deliveries beginning April 17th.
Energy, oil is embedded in everything that we have in the modern economy.
Andre Serra is an operations management professor at the University of Toronto and predicts high prices will be here for many months, even if the war ends soon.
I would say that the only certainty that we have is that it's going to take a long time until the prices, they really stabilize.
While inflation eased in February, experts are expecting a significant increase to the March numbers and say the longer this war lasts, the harder it is going to be for consumers. Heather Wright, CTV News, Toronto.
When we come back, Grant White takes your questions on First Call. Stick around. Time for first call and first email, and that is from Paul. He'd like your guest's opinion on ARX going forward, looking at a 2 to 3 year hold.
Yeah, I think this is a really, ARC's a really great company, and I think this is actually a really great time to be talking about ARC as well. I mean, we know what's going on in the energy story in the world. It was a big story before the war in Iran. It's a bigger story probably today, despite even prices coming back today. We'll see how it goes. But, ARC's really well positioned. I think from a pricing perspective, it's reasonable right now. Very strong profitability, low cost structure it's actually one of the things I really like about ARC is that low cost structure. So they're going to be able to navigate very well no matter what pricing does. And pretty reasonable valuation right now, and you're getting paid to play. So I think over the next few years, I could see it compounding at about 10 to 13% annually, and I think it's really well positioned to do that right now. The next 2 to 3 years, that's kind of where I'd expect it to be, assuming the markets don't fall out on it. But yeah.
And are the markets going to fall out?
No.
Because everybody's been talking about Canadian energy, oil. Yeah. That's with everything that's going on in the Middle East. But it's quick to forget it too when things are resolved quickly, right?
Yeah, your guess is as good as mine. But the good news is they're a good cost producer, and so they should be able to navigate even if prices come back after following the war.
Okay, let's get this email in from Michael. And Mike. I am down 20% on Constellation Software. Should I sell or hold? Constellation.
Constellation. You're not alone in that, Mike. It's that one's been a bit of a ride over the last year. Down 20%. I would say hold it at this point. I think the reality is Constellation is still a fantastic company, and they haven't.
And software's not going anywhere.
Software's not going anywhere, and the reality is the market has punished software companies over the last year, I think unfairly. I think a company like Constellation is actually going to do very, very well over the next few years. Like I said, their management hasn't lost their minds. They're still really strong and really good thinkers, and so they're going to weather through this storm. I think that the baby's been thrown out with the bathwater here, and I think the AI story is going to play really well for Constellation as they look at integration across their platforms. So I would definitely hang on to it. I'm not buying it right now, though, to be honest, because I think there is still headwinds facing companies like Constellation. But in saying that, I definitely wouldn't give it up at this point. You've taken the ride, Mike, so keep going.
Well, and is it a company that can adapt and adjust, and it may end up going in a completely new direction?
Yeah, absolutely. They've shown that they can in the past, and again, let things change from my perspective on them in terms of management. So I would continue to expect that they're going to continue to iterate their company going forward and look for better acquisitions as they've done for decades now.
Okay. Next email is from Michael, and can you tell me if Celestica is a good buy for capital appreciation at this time, or should I wait for its value to drop more?
Yeah, that's a dangerous question because, you could be waiting longer and you might have missed your best opportunity. I think it's in a good position right now, actually. I think, you can certainly look at entering into this one, and I think you'll do okay over the next few years with it. We're seeing improving profitability, expansion, support, strong momentum there. Valuation is pretty reasonable right now, so I wouldn't wait on this because you never know if you're going to get a better opportunity. And so I think, is it a heavy buy? No. But it's something that you can certainly start dipping into, and you can keep adding. And if the pricing improves, just keep adding more.
Okay. Faye now. I am not currently holding CrowdStrike, but thinking of acquiring it. What's your guest's opinion on that?
I would probably wait on this one. CrowdStrike, nothing against the company. It is a good company. I don't think the pricing is quite where I'd like to see it as an entry point. But they've shown really great growth. Margins are strong. The recurring revenue is really strong with a company like this. It's just the valuation is really, really high still, in my opinion. And so I would not be dipping. I think there's just better opportunities out there for money. You're going to do well with it over time if markets do well. But I think that there's just better opportunities out there.
In that sector, like similar to CrowdStrike?
Well. Yeah, so similar. I'd actually go back to Constellation. I'd be buying Constellation today versus CrowdStrike. Yeah.
Okay, there you go. Next up, an email from Brian. I'd like your opinion on Exchange Income Corp.
Oh yeah, exchange income. That's close to my heart back in Winnipeg. So,
Biased opinion coming in right now.
we've owned exchange income for a really long time actually, and it's a fantastic business. We do have it as a buy today, and it's largely just because we think that they're continuing to do really well at capitalizing on their opportunities they're seeing. They've been great at acquiring, especially over the last number of years. This company just weathers storms so well, and largely it's because they have such a great diversified business across multiple industries. And the other side of it is they've got these great government contracts that are essentially recession-proof on a lot of the work that they're doing, especially up in northern Canada. So yeah, it's a great multiplier. The dividend is strong. I know they've had challenges in the past with short sellers, but I think that they've proven that they're a very strong company, and I'd expect 10 to maybe 13, 15% compounding over the next 3 to 5 years is certainly within reason, especially given how strong that dividend yield is.
All right, we're going to sneak in one more email. You got about 30 seconds. This is from Bruce, could Grant comment on a short-term and long-term outlook for Whitecap?
Yeah. Whitecap is another really great business. And I think it's timely to be talking about it. So I would have it as a buy right now. I think pricing is really great. Dividend is quite strong right now too. I think it's just a really well positioned. We've held Whitecap off and on over the last decade, and we have it as a buy right now, and we are buying into it. They've had some great reports. Again, I go back to like the pricing model, and especially with commodities, if you can have a company that can produce really well even at lower pricing, Whitecap looks really good. And so no matter what the pricing can do in short term, I think it's a good one.
Got to wrap it up there. Grant, thanks as always for joining us. Appreciate it. That's it for us here on The Street. Thank you to Grant White for joining us today. He's a portfolio manager and investment advisor at IA Private Wealth. And he's up next with The Open.